Welcome back to the Deep Dive, where we take the vast, overwhelming ocean of information and bring you the clearest, most valuable nuggets of knowledge.
It's great to be here.
Today, we are focusing on a phase that I think often gets overshadowed by all the excitement of, accumulating wealth. We're
Right.
talking about securing the finish line of retirement.
Mm,
We're not just talking about calculating how much money you need. We're diving deep into those critical, often really stressful, special situations that can sink a perfectly planned retirement. Things like outstanding debt, rising, unpredictable health costs, and establishing a clear, legally actionable legacy.
Yeah, it's a huge shift in mindset, really. It's the shift from offense to defense. You're focusing on protection and, frankly, organization.
Right.
Our mission today is a rigorous three-part exploration of risk mitigation. We've moved past the goal of simply accumulating a large retirement corpus. Now, the central goal is protection, making sure the wealth you have built is safe, it's accessible, and it's distributed precisely according to your wishes.
So you're saying we're looking at the points of failure, the things that can derail decades of financial discipline.
Exactly, the cracks in the armor.
Okay, so we've synthesized a detailed assessment of preparedness, and it organizes this whole finish line concept into three critical zones. First, we're going to start with what I think is the single most direct threat to your cash flow, eliminating financial liabilities.
Yeah.
Then we're going to pivot to guaranteeing physical security, which means strategic health planning. And finally, we'll get into securing the future of our dependents through the critical legal documentation and legacy tools.
It's a comprehensive journey. It's moving from accumulation to this sort of ironclad preservation, making sure that money delivers the peace of mind you actually worked for.
Because if we don't handle these mitigation and legal aspects correctly, the best accumulation strategy in the world, even hitting your target number, it can still fail, right?
It can absolutely fail to provide true security. Outstanding debt, an unexpected illness, or just, legal complications at the end can steal years of careful planning. So we have to start where the damage is immediate and measurable.
And that's dealing with debt.
Dealing with debt.
When we approach retirement, the financial world often talks about benchmarks like, your net worth or your investment returns. But when it comes to debt, what is the clear gold standard we should be aiming for? And why is that standard so rigid?
Well, the benchmark for true unshakable financial security as you get close to retirement is, it's remarkably simple. Your debt-to-income ratio should be tending to zero.
Tending to zero. So not just low, but basically gone.
As close to zero as you can possibly get. And this isn't just some metric on a spreadsheet, it's a freedom parameter. High debt is a fundamental financial risk because those mandatory loan obligations, those fixed monthly payments you have to make, they must be serviced from your retirement income.
Which is, by definition, either fixed or it's drawing down from an investment corpus that, goes up and down with the market.
Precisely, it fluctuates.
So let's make that real. If I have, say, $5,000 coming in monthly from my retirement portfolio, but $1,000 of that is a non-negotiable debt repayment, a car loan, a mortgage, a personal loan, my actual financial flexibility has just been slashed by 20% before I even buy groceries.
Exactly. You've locked in a fixed expense using a flexible, or worse, a volatile income source.
That feels like a recipe for disaster.
It is. And that reduction in flexibility isn't the only problem. This situation forces you into a specific and usually a detrimental financial position. If a retiree enters this stage with a large outstanding loan, they may be financially forced to commit more of their funds to a low-return product, something like an annuity.
Wait, why an annuity? I always thought annuities were supposed to solve for longevity risk, the fear of outliving your money, not for debt.
That's a great question, and it's where the trap lies. The problem is the word mandatory. Debt obligations are mandatory. They're non-negotiable.
You can't just decide not to pay your mortgage one month.
You cannot. So if you have to pay a fixed amount every single month for, say, 10 years, you cannot rely on the volatile stock market to guarantee that exact payment. It might be down 30% the month you need the cash.
Okay, that makes sense.
So you must ensure that portion of your income stream is guaranteed, regardless of what the market does. And annuities, for all their faults, provide that certainty of cash flow. It's really the only way to reliably service mandatory debt from your retirement assets.
Okay, let's unpack this, because here's where it gets really interesting for me. The source material we looked at notes that annuities offer very low returns, and they demand a very large initial corpus just to meet essential expenses.
Yeah.
So how big is this trade-off, really?
It's a vicious cycling of low returns. It really is. Let's run a hypothetical here. Imagine you were retiring with $100,000 in outstanding high interest debt, maybe credit cards or something.
Okay. You need about $1,000 a month, let's say, to service that debt. Now, to guarantee that $1,000 payment for, say, 20 years via a standard low-yield annuity, you might be forced to dedicate an initial lump sum of perhaps $250,000, maybe even $350,000 of your hard-earned corpus.
Wow. $250,000 just to pay off a $100,000 debt over time.
Just to ensure that $1,000 arrives every month, you are essentially trading away the potential 8 or 10% returns that money could have earned in a diversified portfolio for a guaranteed inflexible 3 or 4% return.
You're sacrificing hundreds of thousands of dollars in potential growth.
All just to service a debt obligation that, frankly, should have been eliminated years ago.
Yeah.
It's a massive financial drag chute on your portfolio's ability to grow, forcing you into inflexibility and demanding a significantly larger starting corpus.
Which makes the primary focus in the 5 to 10 years leading up to retirement absolutely non-negotiable.
Elimination. That's the goal.
So what's the plan? How do we do it? This is why we recommend a clear 3-step strategy for debt management. It has to be systematic and it has to be aggressive.
Let's walk through the steps. I think the order here is probably pretty important.
It's critical. Step 1 is list and assess. And I don't just mean list the total amount you owe. You need a complete inventory of all your outstanding debt. That includes the precise interest rate, the amount, and the nature of the debt. Is it a credit card, a personal loan, a mortgage, a home equity line of credit?
Everything. Get it all on one page.
Get it all on one page. Then step 2, rank by cost. This is the strategic core of the whole thing. You absolutely must rank the debt for repayment from the highest annual percentage rate, the APR, down to the lowest.
The most expensive to the cheapest.
Exactly. And then step 3 is plan and execute. You create and commit to a concrete, aggressive paydown plan based on that ranking.
And when we're ranking by cost, we're basically prioritizing the liabilities that are actively, as they say, eating our lunch.
Absolutely. The priority focus has to be on that high-cost debt. So we're talking credit cards, unsecured personal loans. These liabilities often carry double-digit, sometimes 20 or even 30% interest rates.
Which is just brutal.
It's brutal. And paying them off provides an immediate, guaranteed, risk-free return on your money that is exponentially higher than almost anything you could hope to achieve in the market. They drain your available income so rapidly. Eliminating them is the very first step toward financial freedom.
Okay, now let's address the elephant in the room, the mortgage. It's typically a much lower cost loan, often in the single digits, but it's usually the largest outstanding dollar amount for most people. Does the strategic advice change here?
The mortgage is treated a little differently, but the objective remains the same. Even though it's a low-cost loan, carrying that mandatory monthly payment still significantly affects your corpus's ability to generate sufficient returns and maintain your monthly budget flexibility.
Because if health costs suddenly surge or inflation spikes unexpectedly, that mortgage payment is still due. It's a sunk cost.
It is. It doesn't care about your other problems. So the best strategic approach is aggressive elimination. Increase your pre-retirement repayments to ensure you are completely debt-free by the day you retire.
Okay, let's unpack this a bit more. If aggressive repayment isn't possible through just your salary alone, sometimes people look at downsizing their primary residence right as they retire. This can be an emotional decision, but how can we make sure that the sale of the old home is integrated strategically into this debt elimination plan?
This is a perfect financial marriage, really. If you decide to sell your large family home to purchase a smaller, less expensive one, the capital you realize from that sale must be used first to repay any outstanding loan amount on that property.
So pay off the old mortgage first.
Pay off the old mortgage or any other high-cost debt you have before you acquire the new house. This isn't just smart bookkeeping. It ensures that the monthly income that used to go toward that mortgage payment is permanently liberated. It's now available for investment, for inflation hedging, or just for covering your essential living costs.
But, life happens. Sometimes we retire, and despite our best efforts, some lower-cost debt lingers. Or maybe we just underestimated our needs. If debt remains, we can't rely solely on the corpus, can we? What are the non-saving strategies we should consider?
This is a really important point. If the liability remains, we have to augment the income stream directly. We just have to. So this means considering strategies that push back the need for that corpus drawdown.
Like what?
Things like extending your work life for a couple more years or pursuing a second, maybe less demanding career. This additional income is then specifically earmarked to deal with those lingering obligations, protecting the main corpus from early liquidation.
This introduces a really fascinating concept that came up in the research, the link between having a second career and the timing of your annuity. What is the strategic benefit of generating income in your early retirement years, specifically as it relates to longevity risk?
This is what we call the definitive longevity hedge. It's incredibly powerful. Every single year you work past your originally planned retirement date is a year that your corpus does not have to fund your expenses.
Right, because your salary is covering it.
Your salary is covering it. That income from employment significantly reduces the number of years the corpus will have to last. It greatly protects you against the risk of outliving your assets. I mean, if you can earn enough in a second career to cover your living expenses for the first 7 years of retirement, you have essentially added 7 years of life expectancy to your financial plan.
That's a profound shift. So use the second career income, which
Yeah.
usually requires you to be physically capable and mentally sharp while you are relatively fit and active. And then once that income tapers off, your guaranteed income stream, maybe from an annuity, can kick in when you're older, less mobile, and maybe physically unable to bring in that additional income.
It creates a perfectly staggered security net. It's a beautiful strategy. And the external financial environment really reinforces this. If you look at the current economic landscape, a sustained falling interest rate regime means the income generated by the fixed income portions of your portfolio will be lower than you expected.
So your bonds aren't paying as much.
Exactly. This lower return almost necessitates seeking alternate income streams like part-time employment, just to augment the corpus's lower resulting income and maintain the standard of living you want.
Before we leave debt, we absolutely need to flag two crucial financial and legal traps. Let's start with the tax trap, which is particularly relevant in systems globally that offer tax-advantaged retirement savings plans.
You have to approach this with extreme caution. In many retirement systems, funds that have accumulated in tax-advantaged vehicles like the 60% lump sum portion of India's MPS, or certain 401k or IRA funds in the US are only tax-free if you use them in a specific manner. Often that means buying an annuity or just holding the cash.
So there are strings attached to the tax benefit.
Big strings. If you divert that withdrawn amount to repay loans, and it wasn't originally designated for a tax-free purpose, that entire withdrawn amount can suddenly become taxable.
Oh, wow.
You could be solving a high-interest debt problem only to immediately trigger a massive, unavoidable tax burden, which could potentially negate all of your financial savings from paying off the debt in the first place.
That's a difficult choice between two pretty bad outcomes.
No.
Now, what if a retiree chooses to carry some debt, maybe a low-cost mortgage, and they're funding it through current employment income? What's the one essential protection they should never, ever let lapse?
If any substantial debt is carried into retirement, continuing your life insurance cover, even if it's a simple term policy, is highly advisable. This cover protects your dependents, and it protects the retirement corpus itself from the liability of having to repay that debt in the event of your death.
You don't want your loved ones to inherit a house that comes with a sudden and demanding loan obligation they can't meet without selling assets.
Precisely. It's about protecting them.
And finally, a quick practical note on property claims. If you're planning to leverage your home for retirement income, say through a reverse mortgage, what must be true about that property?
For eligibility for any loan or reverse mortgage against a residential property, the core requirement is that the property must be free of any claim by other lenders. This is why clearing the mortgage and getting the proper documentation is so critical. If a bank has a legal claim on your property, you cannot use that property as collateral or as a source of capital anywhere else.
So the mandate from this section is crystal clear. Aggressively eliminate high-cost debt now. Strategically use any employment or second career to push back that longevity risk and defer your guaranteed income. And be hyper-aware of the tax implications of using protected funds for debt repayment.
That's it in a nutshell. Once we've locked down the money side and stabilized our cash flow by eliminating that mandatory debt, the next massive variable that threatens a finish line is, well, our own health.
Right. Moving on to Section 2, we have to tackle the most volatile and often devastating element of retirement spending, healthcare. We all know medical costs are expensive, but why are they so notoriously difficult to accurately model into a long-term retirement plan?
It's a huge challenge. Medical costs are not only one of the biggest expenses in retirement, but they are also by far the most difficult to estimate and provide for. I mean, we just cannot predict when, how severe, or for how long a serious illness will last.
We can estimate rent or food costs pretty well.
We can. But a major diagnosis can instantly wipe out years of savings, making the duration and severity of the expense just fundamentally unknown variables.
And crucially, we can't use general inflation numbers here, which is a mistake I think a lot of financial models make.
Absolutely. It's a common and dangerous error. You have to assume that the inflation rate applicable to health expenses is typically much higher, often double than that for general consumer costs.
Why is that?
Well, it's driven by a few things. Technological advancements, so new, expensive machines and procedures, increased utilization because we're living longer and requiring more care over that longer lifespan, and cost shifting within the healthcare system itself. So if your general inflation assumption is, say, 3%, you might need to model your health inflation at 6 or 7% just to be safe.
This complexity means a comprehensive plan has to look beyond just the big catastrophic events, right? What are the distinct categories of health costs we need to be planning for?
We have to plan for three pillars of expense. First, you have hospitalization. Those are the big, sudden costs that are usually covered by insurance. Second, you have out-of-pocket expenses. These are the routine and non-reimbursable costs. Monthly medicine, specialist doctor's visits, diagnostic tests, copays, deductibles.
The things that sort of bleed you dry slowly?
They erode your monthly income subtly but surely. And third, and this is perhaps the most overlooked, are the costs related to long-term care. This involves prolonged assistance with daily living activities, often at home or in a specialized facility, and it can quickly become a massive multi-year expense.
This brings us to the strategic defense, which has to be health insurance. Now, even if I have fantastic corporate paid employer coverage right now, the advice is a bit counterintuitive. It's to buy private health insurance early. Why the redundancy?
This is a classic example of planning for future access and price stability, not for your current usage. It is highly advisable to purchase private health insurance early, before you retire, even with employer coverage, for three main reasons.
Okay.
One, you lock in lower premiums because you're buying it when you're younger and demonstrably healthier. Two, you allow the crucial waiting period for covered diseases to pass while you're still working and can absorb that initial cost. And three, you avoid the risk of developing a health complication later in life that could suddenly make you uninsurable or subject you to prohibitive premiums.
So you are essentially pre-qualifying for your retirement health needs at a point when you are the least risky to the insurer.
Precisely. And in many regulatory environments globally, there's a mandatory feature that retirees must absolutely insist upon. It's called lifetime renewability.
Explain how important that feature is. What does it do for your security?
It's the assurance that your coverage will not abandon you when you need it most. Mandatory lifetime renewability ensures that your health cover remains adequate as you age. And crucially, the regulations often stipulate that premium increases cannot be linked to the claims you make.
So if you have a major surgery, they can't just single you out and quadruple your premium.
Exactly. They can't drop you or suddenly hike your premium based on that specific claim. They can only raise premiums for the entire age cohort, which guarantees you continuity of care regardless of your claim history.
Even with robust insurance, there are still the out-of-pocket expenses, the deductibles, the copays. That requires cash on hand. So we have to build a specific health corpus. Once that's built, how should it be structured? We're talking about accessibility and liquidity here.
Yes, the corpus you create to meet those uninsured and out-of-pocket health expenses has to prioritize liquidity above all else. You cannot afford to wait 6 months for a stock market recovery if you need to pay for a treatment today.
Right.
So the recommendation is to move funds into highly liquid assets. Think short-term money market funds, treasury bills, or high-yield savings accounts. And you need enough in there to cover at least 3 years of your estimated health expenses.
Why 3 years specifically? What's the logic there?
The 3-year buffer is a hedge against what's called sequence of return risk. If a medical emergency hits you during a major market downturn, you have immediate cash available for 3 full years without being forced to sell your growth assets at a loss. The remainder of your health corpus can then be held in slightly less liquid, low-risk products that offer better returns. But that initial 3-year segment must be instantly accessible.
This leads perfectly into spousal independent protection. The entire plan really has to be built around the financial needs of the surviving partner. Why is the assumption that the death of one spouse significantly reduces expenses often such a dangerous flaw in retirement modeling?
It is a common and a deadly assumption. The corpus has to be adequate to cover expenses for the lifetime of the surviving spouse or dependent. While certain discretionary costs, like, travel or hobbies, may decrease after one partner dies, the large fixed costs often remain almost entirely unchanged.
Things like housing, utilities, property taxes, maintenance.
Exactly. And often the premium for the surviving spouse's health insurance, those things do not go down. So if the plan was based on the corpus running out shortly after the first death, the survivor is left severely exposed and usually at a moment of extreme emotional distress.
And this brings us to the issue of access, which can often be a bureaucratic nightmare in a moment of crisis. If the primary financial planner or the high earner partner becomes incapacitated or passes away, how do we ensure the surviving spouse isn't cut off from their own required retirement income?
This is non-negotiable legal and financial hygiene. Joint holding on investment accounts and bank accounts is absolutely crucial. It ensures that the surviving spouse is not constrained by legal delays or lack of access to the available retirement income immediately after a death.
But it's not just about death, right?
No, and we have to consider the risk of incapacitation as well. If the primary decision maker is suddenly hospitalized or suffers cognitive decline, joint holding ensures the funds designated for living expenses can still be accessed seamlessly to pay the bills. Without that joint access or a properly executed power of attorney, the family can be paralyzed financially while they're navigating some really complex legal hurdles.
It's a protection against chaos. Joint access isn't just about convenience in daily life. It's a fundamental risk management strategy for retirement income continuity when circumstances become frighteningly unpredictable.
That's right. So we transition now to the final pillar, securing your legacy. You've successfully navigated the debt and health risks, ensuring the money is there. Now we ensure that accumulated wealth is passed on exactly as you intended without being eaten up by legal costs or, worse, family conflict.
Okay, so what is the formal, structured process that ensures this transition is smooth and intentional? What is the actual definition of estate planning?
Estate planning is the process of organizing an individual's wealth for distribution after their death according to their explicit intention and desire. It is an act of proactive control. You're moving the asset transfer from the slow, expensive realm of legal default to clear, personalized direction.
And what are the concrete, measurable benefits of taking the time to do this? I mean, it requires difficult conversations and a lot of detailed preparation.
The benefits are tangible, and they often save exponentially more than the cost of the planning itself. Effective estate planning results in, well, first, reducing conflicts and legal complications among your heirs, which preserves family relationships.
That's a big one.
Huge. Second, minimizing the time involved in the wealth transfer. Your assets can move in months instead of years. And third, reducing associated costs and taxes in that transfer process. So it provides efficiency, clarity, and peace of mind.
The cornerstone of this entire effort is, of course, the will. What is the precise legal definition of a will?
Legally, a will is the legal declaration of the intention of the testator. That's the person making the will, with respect to his property, which he desires to be carried into effect after his death. It is the definitive voice of the deceased regarding their assets.
And what makes a will legally valid? It doesn't need to be notarized everywhere, I know, but it does require strict adherence to some very specific steps.
That is the critical point. To ensure validity, a will must be written and signed by the testator in the presence of two witnesses. The witnesses must also sign, acknowledging that they saw the testator sign the document and that they believe the testator was of sound mind.
And if these basic execution formalities are missed?
The will may be challenged. Regardless of how clearly the intent was stated, it could be thrown out completely.
What happens if you skip this step entirely, or if the will is deemed invalid? If a person dies, what's the term, intestate?
Yes, intestate. If a person dies intestate, meaning without a valid will, the property will be inherited according to the laws of succession that are applicable to them. These vary by jurisdiction and often by religious or communal law. This process can be incredibly slow, costing the estate time and money, and most dangerously, the distribution prescribed by the law may be entirely contrary to what the deceased person actually intended.
Here's where it gets really interesting for me. In most wills, people list specific gifts. The house goes to person X, the stock portfolio to person Y. But people often forget about the unexpected things, maybe an asset that arrived after the will was written, or small accounts they forgot to name. This is where the residuary clause steps in.
The residuary clause is the unsung hero of estate planning. It really is. Its purpose is to leave all assets that remain uncovered in the specific bequest to an identified beneficiary or group of beneficiaries.
Like a catch-all.
It's the ultimate safety net. Without it, any asset you forgot to name, a forgotten foreign bank account, a new investment, a digital asset, an unexpected inheritance from someone else, all of that would fall back into the process of intestacy by omission, forcing unnecessary legal action.
That one detail separates a functional will from a complete, robust estate plan. Now let's move to the most frequent source of family confusion and conflict: the critical distinction between a will and a nomination. What, again, is a nomination?
A nomination is simply an administrative right conferred by a financial institution. It's the right given to the holder of an investment product, a bank account, a mutual fund, or retirement policy to appoint the person who is entitled to receive the money administratively in case of death. It just simplifies the payment process, ensuring the funds leave the institution quickly.
But, and this is the key, ease of administrative transfer does not equate to ultimate legal ownership.
This is the moment we need the listener to truly grasp. The provisions of a will always supersede a nomination. A nominee is viewed legally as a trustee who holds the money received for the benefit of the legal heirs named in the will.
Okay, let's use an analogy to clarify this because it's so important.
Yeah.
If I nominate my sister on my checking account, but my will states that all my assets go to my two children equally, what happens when I die?
Okay. The bank will release the money to your sister, the nominee, very quickly because she is the administrative contact. But your sister holds that money as a trustee. The will dictates that the money must ultimately go to your children.
So my sister is just the delivery driver.
She's the delivery driver or the temporary custodian. The will is the shipping label, telling her who the package is ultimately for. If the will contradicts the nomination, the will always wins.
That clarifies the entire situation. So if someone wants their nominee to truly be the ultimate beneficiary, they have to ensure their will explicitly states that intention. Otherwise, the nominee is just handling the money for the benefit of the legal heirs.
Misunderstanding this simple legal hierarchy is responsible for an enormous number of drawn-out family lawsuits, wasting the very wealth that was intended to provide security. It's paramount to get this right.
Moving beyond the will, let's discuss some alternative legacy tools. A crucial document for managing retirement in the event of incapacitation is the Power of Attorney, or POA.
The POA is a critical instrument, especially for elder care. It's a legal document authorizing another person, the donee or agent, to formally act on behalf of the principal, the donor or principal, either globally or for a specific transaction.
And there are two main types, right?
Yes. A general POA is broad. It enables the donor to act on all matters managing investments, paying taxes, cashing checks. A specific POA is restricted. It limits the donor's authority to only a single defined transaction, like signing a lease agreement for an apartment.
And for proactive retirement planning.
We typically focus on a durable POA, which remains effective even if the principal becomes mentally incapacitated. That ensures continuous financial management when it is needed most.
And if a POA was executed years ago, maybe naming a child, what kind of maintenance is required to ensure it is still enforceable later?
You have to diligently maintain the document so that the POA is not challenged in the future. Challenges often arise when the documentation is unclear or there's a question about the donor's mental capacity when they signed it. So reviewing it periodically and ensuring all supporting paperwork is secure prevents legal battles down the road. It's a document that protects your autonomy and your dignity.
For those with substantial or complex estates, what about more sophisticated structures like trusts?
Trusts are essential legal structures for sophisticated wealth transfer, complex tax minimization, and layered control over assets, often spanning multiple generations. The trust deed is the defining contract.
And what has to be in that?
It must clearly define three things. The intention to create the trust, it has to identify the specific property to be transferred, which is the corpus, and it must list the designated beneficiaries and the trustees.
You highlighted a key protection that an irrevocable trust offers regarding financial security. Could you explain that?
That's a significant structural benefit. An irrevocable trust can protect the future financial stability of the beneficiaries. Once the assets are irrevocably placed into this type of trust, they are legally separate from the person who established the trust, the settlor. This means the assets are protected from the bankruptcy or the creditors of the settlor. It's a very robust shield for dependent interests.
And a final quick mention of gifts as a mechanism for wealth transfer while the individual is still alive.
Yeah, gifts are used to systematically transfer wealth, often leveraging various tax codes that provide exemptions from tax available on certain gifts, particularly those given between relatives or received on marriage. This is a deliberate strategy to reduce the eventual size of the taxable estate, allowing wealth to bypass potential inheritance taxes later on.
Okay, now we move into the crucial administrative side of all this. The logistics. None of the legal documents we just discussed are effective if the supporting paperwork is missing or if the assets are unknown. What are the key items on the documentation checklist? Let's start with the essential asset list.
Maintaining a comprehensive, updated checklist of all your assets and liabilities is absolutely non-negotiable for effective estate planning. It just is.
Why is it so critical?
For two reasons. First, it ensures all the assets you accumulated are actually available for your beneficiaries. It prevents accounts from being forgotten and money from sitting unclaimed for decades. And second, and just as important, it prevents unfounded claims against the estate because the executor has the complete, authoritative financial picture.
This next point is extremely counterintuitive for retirees. Tax returns. Why must a retired individual continue filing income tax returns even if they expect to pay zero taxes due to low or tax-exempt income?
This is purely a long-term strategic move for access and credibility. Filing the tax return, even a zero liability return, establishes your creditworthiness with financial institutions.
Really? Even with no income?
Yes, because in retirement, you might need a line of credit for an unexpected major home repair, or you might need a temporary bridge loan. Having a history of filing tax returns makes accessing credit at better terms significantly easier, as banks view it as proof of financial hygiene and continuity.
That's fascinating. So the administrative hassle is a proactive investment in your future financial access. And thankfully, e-filing makes the preservation of these documents much simpler than dealing with stacks of paper copies.
Absolutely. The digital record eliminates the risk associated with physical documents. For older accounts, losing original investment certificates, like for legacy bonds or physical shares, results in massive delays and so many formalities to establish ownership at the time of maturity or redemption. We are talking months, sometimes years, of bureaucratic entanglement.
So secure or dematerialize any physical certificates you have immediately.
Yeah.
Finally, let's address property specifics. For most people, their house is their single largest asset, and the documentation must be impeccable, especially for legacy planning. What is the significance of the sale deed?
The sale deed is the foundational document. It establishes ownership on the title of the property. It must be the original registered document. If this is lost or damaged, establishing legal ownership becomes exponentially harder, and your legal heirs will face immense difficulty transferring or selling the asset.
And what about the encumbrance certificate? This is a term listeners may not be familiar with.
An encumbrance certificate is issued by the local registrar's office. It confirms that the holder has clear title to the property by listing every single transaction ever recorded against that property, all sales, purchases, and critically, any outstanding mortgages or liens. It ensures there are no hidden legal claims on the property that could complicate a future sale or transfer.
And if a mortgage was paid off years ago, what's the key document required to prove that the lien is truly gone?
When you close any loan secured by property, the required final piece of documentation is the No Objection Certificate, or NOC, from the lender. The NOC is essential because it confirms that the hypothecation, which is the legal right the lender had over your property, has been cleared and all your dues have been met.
Without that NOC,
the loan is technically still registered against the property title, which will cause huge problems down the line.
that is a critical detail that I'm sure many people miss in the relief of making their final mortgage payment.
Indeed. It's the final administrative step of true debt freedom.
Let's briefly cover a few special situations for certain groups of listeners, starting with non-resident Indians, NRIs. The decision of where to retire has massive financial consequences.
For NRIs, clarity on their intended country of retirement affects everything. The cost of living, local inflation rates, access to healthcare services, and complex international taxation rules. All of these factors fundamentally influence the required corpus size.
And there's a currency issue too, right?
A big one. When they eventually repatriate investment proceeds from India back to their country of residence, currency depreciation can reduce the effective yield to the investor. They have to proactively factor that foreign exchange risk into their return expectations.
And for any NRI who has a pension or retirement account in their home country, like an MPS account, what specific documentation is required?
If an NRI is investing in such a structured product, they must submit a copy of their passport in addition to the standard identity and bank details. This is necessary to confirm their non-resident status for regulatory and tax purposes.
Okay. And one final note for employees everywhere regarding severance or separation benefits like gratuity. Usually, continuous service is required, but that condition can sometimes be waived.
Yes. The 5-year continuous service condition required for receiving gratuity is often waived if the termination is due to death or disablement. This is a crucial financial protection mechanism for the employee's family or the individual if they are forced to stop working early due to sudden unforeseen health issues or an accident. It ensures they receive that accumulated benefit regardless of the duration of their employment tenure.
Good to know.
Today's deep dive confirms that retirement security is achieved not just by the size of your balance sheet, but through meticulous organization, legal clarity, and proactive planning for the worst-case scenario.
So what are the key takeaways?
Well, the key action items for you, the learner, are clear and immediate. Prioritize the elimination of high-cost debt to protect your cash flow from that annuity trap we talked about. Insure early for health to lock in terms and waiting periods. Ensure all your core financial documents are jointly held to protect against incapacitation. And remember the definitive rule. The will supersedes the nominee in determining ultimate asset ownership.
That distinction regarding the nominee being merely a trustee is truly essential knowledge for anyone undertaking estate planning. Retirement is a special set of circumstances requiring legal organization as much as financial accumulation. You can't just set the money aside and walk away. You have to meticulously set the rules for the transfer and protection of that money.
And we spent significant time emphasizing how a second career provides a tremendous longevity hedge, essentially reducing the risk of outliving your corpus by shrinking the required drawdown period.
And that leads us to our final provocative thought for you to chew on. We discussed the benefits of a second career protecting the corpus from longevity risk. Given the flexibility and the low-cost nature of digital, remote, and skill-based work available today, how might proactive preparation for a low-intensity, skill-based third career, one that starts 10 years before retirement, perhaps in your late 50s, and is designed to run for profit and pleasure, further enhance that protection? By having established flexible income streams that run well into your 70s or even 80s, long after the primary corpus drawdown begins, could this intentional third career preparation ensure income continuity even when traditional part-time employment becomes physically impossible? Could it make true longevity risk virtually irrelevant and maximize the security of your final finish line?
Something to ponder as you review your debt, finalize your will, and look for those missing no objection certificates.
Absolutely. Thank you for joining us on the Deep Dive. We'll see you next time.